everyone, I'm Radhika Mervin, and this is the big picture on monetary policy. One of the primary tools of the monetary policy framework is the repo rate. When you and I need funds, we go to the bank to borrow money. Likewise, banks also need to borrow funds for their short-term needs from time to time. This does not mean that banks run out of cash. It's just that they face liquidity issues when their deposits and loans don't come up for payment at the same time. To avoid short-term liquidity crunch, the RBI mandates that banks set aside a part of their deposits in cash reserve ratios and also invest about 21.5% of their deposits in government securities. Government securities are highly liquid and they can be sold at any point of time to raise money. Banks on an average today hold about 27% of their deposits in government securities. This gives them an extra cushion. Say for instance, a bank has a deposit of a lakh of rupees. It sets aside about 27,000 rupees in government securities. This is more than 5,000 rupees that they really need to maintain under the RBI's requirement. Banks can pledge these extra securities with the RBI. This is where repo rate comes into play. The repo rate is the fixed rate at which banks borrow funds from the RBI by pledging their excess government securities. This is the rate which is reviewed in every monetary policy. Now let us look at all the objectives of the monetary policy and how they are met by tweaking the repo rate. The first objective is of promoting growth. It is understandable now that to promote growth, we need to induce demand. And this can be done by reducing the cost of borrowing so that spending can increase. The RBI reduces the repo rate if it wants to promote growth. The moment the RBI reduces the repo rate, the cost of borrowings for banks comes down. This benefit is then passed on by banks to the customers in the form of lower lending rates. The RBI thus reduces the repo rate to kickstart growth. Let us look at the second objective of controlling inflation. The Reserve Bank of India increases the repo rate to rein in inflation. As the cost of borrowings of banks goes up, the interest rates on loans also goes up. This dissuades the customers from borrowing and spending more. The third objective of the Reserve Bank of India is to stabilize currency. The Reserve Bank of India normally stabilizes the currency by tweaking the demand and supply of currencies. But under extreme situations, the RBI has used the interest rate tool to stabilize currency. For now, it is important to understand that when the repo rate increases, the real return on government bonds looks attractive to foreign investors. This leads to increase in inflows and helps the RBI to curb the fall in rupee. A related concept is the reverse repo rate. This is the rate at which the RBI borrows money from the banks. When the banks have excess liquidity, they park some of their funds with the RBI. The interest they earn on lending these funds to RBI is the reverse repo rate. Normally, the reverse repo rate is a percentage point lower than the repo rate. Let us look at what the RBI has done in recent years. In the wake of the global financial crisis in September 2008, the RBI chose to adopt an aggressive money easing policy and followed it by a series of reductions in policy rates. Between October 2008 and April 2009, the Reserve Bank of India reduced the repo rate by more than 4 percentage points from 9% to 4.75%. In the second half of 2009-10, growth started to pick up, but inflation became a cause of worry. The Reserve Bank of India switched to a tightening policy and started to increase repo rate. Between March 2010 and October 2011, it increased the repo rate from 4.75% to 8.5%. In 2010, when the economic slowdown once again became a cause of worry, the Reserve Bank of India started to reduce the repo rate once again. But unfortunately, this rate easing cycle was very short-lived. In July 2013, inflation and currency played havoc. The Reserve Bank of India started to increase the rates once again. It was only in January this year that the Reserve Bank of India once again started to reduce the repo rate. While the repo rate is a key policy rate, it has been ineffective in the past. This is the reason why the RBI has introduced a new term called the term repo rate, which we will look at in the ensuing session.